What's up, guys? I'm glad you're here. My name is Drake, and you're listening to the Double Click Podcast by Holy Hill Media. All right, man. Thanks for hopping on again, brother. I appreciate you, dude. This is actually like our third conversation. Every time we're like, we need to record it. And so this is our first formal podcast recording, man. But it's been a long time.
We never hit the record button. And then afterwards, you're like, well, that was pretty valuable.
Yeah, 100%, man. And I knew it was like, it's a matter of time before we get you on, man. So Steven Speck, managing partner with Rustbelt Capital. I've known you now for going on 2-3 years.
Yeah, probably
something like that.
3. Yeah, quite a while.
Been a while now, man. Introduced through a mutual friend, Gavin. And man, I'm excited to have you on, man. Based on the value that you bring in the conversations I've had with you, your mind of an investor, all the books you recommend, man, tough to chew, but they're super valuable.
Like they tickle your brain, don't they?
Tickle your brain, exactly, man. The Intelligent Investor. I've literally been working through that book for like a year now. So
it's like 1,000 pages, and it's 100-year-old language, right? It's very archaic.
I'm like, how can I use GBT to like modernize the way that it's written so I can actually digest it in a week?
Yeah, please summarize and make easier.
Exactly. So, man, I appreciate you hopping on. I would love for you to, of course, man, I would love for you to just kind of start with who you are, what you do, and then how you got to this place. Because, the thing that I love that you always say is like, you're an investor first and you happen to be in real estate now because of that. And so I kind of want to just follow the trail of your experience to getting to this point, especially landing on real estate with the current investment company that obviously that you're managing within Rustbelt Capital. So, yeah, man, take it away. Tell us a little bit about yourself.
Yeah. Well, thanks for having me on again. And so what I do, I'm one of the managing partners here at Rustbelt Capital. We're an investment firm, like a private equity firm, and we specifically focus on workforce multifamily housing in the Midwest. Very, very focused on that and very, very niche down. How did I get here into this position? Gotta go back to memory lane a little bit. But I grew up on a farm right in Northwest Ohio around Bowling Green, about 1,000-acre row crop farm. And I remember growing up, my father was a commodity trader. You're growing up around commodities, agricultural commodities, and I thought that was what I was going to do. So I, come of age, go to Ohio State, get some internships, go work in Chicago, go work in Kansas City, and it was interesting, but I could see the shift in the industry. Back in the 80s, there's a lot of opportunity. Margins were high. Everything was abundant. You could really make something go, whether you're an employee in a business or if you wanted to figure out how to make your own company or your own way. But when I was there, right, I don't know, 7-10 years ago, those opportunities were going away. Consolidation within the industry and margins were low. And I was like, this is cool, but if I ever want to own a business, this is not going to be doable. So start looking around, right? I'm in university right now. I'm like, okay, I got to find something else. How do I figure this out? And I remember sitting on my grandmother's couch and making the decision that somehow I'm going to figure out how to own a business. And it's not just a business. I wanted to own a very big business, like a big business, right? But how the heck do you do that? And so I, wasn't very smart or educated at that time. So I'm like, dude, investing, it's got to be the way. It's got to be the way, right? So I go on this whole journey. I read The Intelligent Investor. By the way, Intelligent Investor is written by Benjamin Graham. This is the mentor of Warren Buffett. Warren Buffett, probably the greatest investor to ever live, created Berkshire Hathaway, et cetera, et cetera. And when you read The Intelligent Investor and then you follow the story of Warren Buffett as he implements all this stuff, you learn about leverage, right? And so I'm sitting there in my apartment at college reading through this 1,000-page book and trying to figure out what the heck these people are saying and using words like remunerative. What the heck is remunerative, right? All right. Basically means there's an ROI on what you're doing. But anyways, sitting there in the apartment at college, reading it, and I'm like, okay, There's something that he has that I don't have millions of dollars to go out and buy a business. How am I gotta find a business small enough to buy, right? So that led to real estate. And so it's like, okay, I can buy real estate because it's a business, and I can borrow money, which is leverage, borrow money to buy the business, which is a key strategy that Buffett used. And so when I had those internship with the commodity companies out west, I'd go work 9 to 5, see what they're doing, see all that type of stuff. And I'd come home and I'd underwrite, or I'd go on realtor.com, try to find 1, 2, 3 unit little apartment buildings, get whatever the rents were, what was the market price of it, and then do the math. Does it make money? Does it not make money? Et cetera, et cetera. And I did that for honestly years, every day, till your eyes go numb, right? Doing that. And that kind of developed this skill. And as time went on, I started finding some opportunities, and then I found a really big opportunity, one that I couldn't take down on my own, and it was a 64 unit apartment complex. And so I called my buddy. My buddy's Nate. He's the other partner here. I'm like, Nate, I've got an idea. I think you're going to want in on this. And he's like, all right, this is whatever. I'll take the lunch meeting. That's fine. So I meet him at lunch to show him the property, do the underwriting, show him the math. He's like, this checks out. I'm like, dude, we got to make a move quick though. We got like 24 hours to figure this out. One thing leads to another. Get on the phone with the person selling the property, convince them to sell it to us, find the money to put it together, and there you go. That's the beginning of the company, and that's 3 or 4 years ago at this point.
Wow. So that first deal, man. Well, first of all, I want to take it back a little bit further. The underwriting.
Yeah.
Those were the reps, right? That was being in the gym when no one was around. You know what I mean? You wasn't with me shooting in the gym. And the reps, until your eyes go numb. The underwriting, that process, you said you developed a skill.
Yes.
That skill being finding opportunity.
Yep. Being able to see it.
Being able to see it. What does that really entail? Obviously, underwriting, it means something different depending on the assets you're evaluating.
Sure.
But what are the core elements of true underwriting? Like, what are you looking for? You're obviously running numbers. It's kind of black and white, but what are those skill sets that it takes to be capable of doing that? Because when I talk to you, man, you spit numbers out quick, boom, boom, boom. To me, I'm like, pen and paper, my calculator, I'm trying to figure out what's going on. What does that process of underwriting really look like? And what are the skills that really develop, that ability to find that opportunity?
Yeah. So like you said, putting in the reps. Okay. So I'd go work a full day of work as an intern. I'd come back. It's 5:30, 6 o'clock by the time I get home to my apartment. And I'd go look at listings in one market. Maybe it's Toledo, maybe it's Columbus, maybe it's Cincinnati. And I go and I work through as many as I could get through until like 10 o'clock at night. And I did that stuff for 2 years because I didn't have the confidence that what I was doing was right. Okay, this thing apparently is going to make 8% return.
Mm-hmm.
But is it really? Where did I mess up? Right. So I did that for like 2 years. But to answer your question, what is underwriting? Underwriting, is you go look at a property and you got to figure out how much top line revenue am I actually going to make? What's at the end of the year, how much am I going to collect in rent? Okay. If you think you're going to collect 100% of the rent, you're already wrong. There's no way. You're not going to. I don't care if it's a house. I don't care if it's 4 units. I don't care if everybody's a cousin in this place. You're not going to collect all your rent. All right.
Probably less rent if they're cousins too.
Yeah, maybe less. Jimmy needs braces this month or something. I don't know. Okay. So if you look at a property and it's 4 units and they're all 1 bedrooms and they say the rent's $775, is that rent realistic or not for that area? You've got to know the area, right? Because they might say it's $775, but in actuality, it's not, right? Or you also might know that $775 for a 1 bedroom in Dublin Ohio, right, is way cheap. Maybe it should be $1,000 a month, right? You've got to know that because you got to take that into account in your underwriting. Okay. Let's say it's 775. Let's give them that. Let's just take it face value. So you got 775, you got 4 units, 775 multiplied by 4. And you're going to say we're going to have somebody that doesn't pay their rent at some point in time. We're going to have no move outs. So what we're going to do is we're going to multiply it by 95%, meaning we're going to collect 95% of that top line revenue that we're supposed to collect, or 90%. So this gives you breathing room, right? So that'll give you 775 times 4. That'll give you, then multiplied by 95. That'll give you what you're going to collect in a month, right? Multiply by 12. That gets you to a year. Now you've got expenses, right? So what are the expenses when it comes to apartments? Super simple. It's a super simple business. You've got your maintenance expense, and typically that's a percentage of your total revenue. You know, if it's an older property, you're going to use, let's say 12%, 12% of your top line revenue to be conservative. You've got management. Okay. That costs something, probably 10%. You've got taxes. That costs something. What is that? By the way, when you buy a property, your taxes are going to reset. They're going to go higher, right? So if they say taxes are, $1,000 a month, expect them to be higher after you buy it. And then you got insurance. Right now in the multifamily space or just in habitational in general, insurance is a wild card, man. We had one property go up 300% in a year. We got a different quote, obviously. We got it down, but we got quoted almost 300% increase, which is wild. If you don't account for that, that could bust a deal. So those are, those are your main expenses. And then what you're left with once you subtract those out is called your NOI, your net operating income. Okay. That's your top line revenue with the little buffer for what you're actually going to collect, subtracting out your expenses, and that'll leave you with your NOI. The NOI tells you how much money you would make if you bought the thing 100% cash. Okay. Most people get into real estate because they're not going to pay 100% cash for something. They want to take advantage of leverage, which is borrowing money. A lot of advantages, a lot of reasons to borrow money. You got to do it responsibly. Okay. So NOI tells you how much money you have left to pay or go towards a mortgage payment. So if you have, $1,000 of NOI, you can pay up to $1,000 a month in a mortgage payment. Typically, a bank's not going to let you do that, but theoretically, that's how much you have. So and then whatever you have left after that mortgage payment is your cash on cash return. So if it's $1,000 and your mortgage payment's $1,000, then you got $0 left. So if you put any money down, you're not going to have any cash return. You following what I'm saying?
100%. Absolutely. Now, this is interesting really quick. I want to pause for a second because this isn't your first time investing though.
No.
This is definitely not your first time investing. Neither was real estate your first dabbling in investing.
No.
What I hear from you every time we talk, it's like to your quote that you always say, you're an investor first, and real estate just happens to be the best form of investment that you have right now, right?
Yeah.
Most people, I feel like, or want to tend towards what they know and try to find an opportunity in what they know. 0 to 1 by Peter Thiel, which is a book you recommended to me as well.
Good one. You like it?
Great book. I love it, man. I'm actually
wildly smart.
It's so good, but he talks about really just looking for opportunity versus just creating opportunity in what's familiar, right?
Mm-hmm.
Follow the money is one of the chapters, right? I think it's chapter 7.
Mm-hmm.
Why real estate? Why real estate? Because you've done trading before. You've been in different I guess areas and in passive investment. Why real estate and why real estate now?
Yeah. So like you said, before I was a real estate investor, I had a lot of money in the stock market and was in stock picking and stuff like that. And I did really well in stock picking. Right. But there's two things that you can't do when it comes to stocks or equities versus what you can do when it comes to real estate. Okay. And let's make it 3. Number one, real estate, specifically multifamily, is a very simple business. Simplicity is a huge asset to business owners and a huge asset to investors. The more complex things are, is the more places for things to go wrong, right? So if it's a simple, well-known business, it gives you the ability to borrow because banks are willing to lend on it, right? So if you can borrow, that gives you leverage. In the stock market, when you go and invest in the stock market, you can't borrow money, or not for a long-term investment. It's very risky. But with real estate, you can. Okay. So why am I so worried about borrowing, right? Because it enhances your returns. Typically, if it's done right, borrowing money can enhance your returns. So I'll put it this way: in real estate, for every $10,000 you invest in real estate, especially in the Midwest, typically you get a 3x leverage power. So you can buy $40,000 of real estate for every $10,000 you have invested in it, right? If you go to the stock market and you invest $10,000 in the stock market, you have $10,000 in the stock market, not 40,000. When you go to real estate, that's what you get with real estate. You get 40,000, not 10,000. So right there is a huge advantage alone. But on the numbers wise, say you're just an average normal investor. The best we can do is an 8% return over 10 years, right? That's the stock market. If you add some leverage to it, then it's not unreasonable. It's very reasonable, actually, to say, heck, we could probably make 15% a year. And the difference between an 8% return and a 15% return is not 7%. Okay. I think there's an example in the book that I wrote. It's the difference between 10% and 15%. Okay. Some kid invests $25,000 in the stock market, makes 10% a year for the next 40 years. You know, that's normal. What are they going to have at the end of their investment career? $1 million. So 25,000 turns into $1 million over 40 years at 10%. If you change one thing, and that's going from 10% to 15%, at the end of that whole 40 years, they have 6.6 million instead of 1.1. Okay. Huge difference, almost an order of magnitude difference, right? And all they had to do was get in a better opportunity vehicle. The time's the same. Your initial investment's the same. The only thing you have to do is get into a better opportunity vehicle. So that's where the leverage comes from. So
very interesting, man. So this is the kind of stuff that it's so easy to get into the weeds of, like, when you think, I want to own a big business. Initially that's kind of initially it was in agriculture, and then it's like, I want to own a big business, right?
Yeah.
Which, first of all, explains your mindset a little bit. And I want to get into that in a second, but when you zoom out, what I love about the things that Buffett talks about in investing is, like, he invests in good businesses, plain and simple, right? Zooming out, he doesn't care necessarily what the business is. If the underwriting is proving to be of fruit,
yeah,
that's transferable to any business. Now, real estate, though, is what you've chosen, obviously, because the return is exponentially disproportionate. When you look at real estate, when somebody wants to get into real estate, somebody doesn't have a friend that they can call up and say, hey, man, let's get some lunch. Let me bend your ear on another business idea. Check me out. I've got this idea. We're all going to get rich.
Yeah.
How does somebody, though, because I think one of the things that I don't like about Grant Cardone, he's like, you know what I mean? Start with the 100 doors. You just got to start with the 100 doors. Figure it out. Like, that isn't practical. Or even if it is practical, there's a paywall before you can actually figure out how it is practical, right? To follow the steps actually making that happen. If somebody wanted to get into that today, you know what I'm saying? Like, if somebody wanted to get into that today, what you told me, first of all, and what you talk about with leverage and investors is, like, you don't need a ton of money up front because there's money out there.
Correct.
So some people need to find the skill of obviously understanding leverage and finding investors. The other people have some cash on hand. Business owners, maybe they're sitting on cash, but at the end of the day, my buddy Steve DeTrey with Freedom Path Planning talks about this all the time. He helps businesses plan for an exit for their business when they're ready to sell.
Okay.
Most businesses don't sell. And the ones that do sell, 17% of any businesses right now that are active are going to sell. 17%. But there's a vast majority of business owners who are relying on their business to sell for retirement.
Okay.
But what we've talked about is the stability of real estate as an investment.
Yeah.
How can somebody that's in that position, considering how they're going to retire, or even considering just how to get into real estate, they're thinking big like you, doesn't matter the why. Getting started though, what does it look like for somebody to get started in real estate? Do you recommend going? Because I know you don't really like single family. Like, do you recommend somebody does that, underwrite to single family, get to single family, learn how to do that? Or do you think they should like find the cash investors or in leverage and just get, a multi-unit complex, maybe 8 doors or something like that? What does getting started look like, I guess?
Yeah. So I'll address 2 things. You mentioned Grant Cardone. He says start with many, many doors, not with small doors. And some people might call him an asshole for that. Like, dude, okay, bro, let's be real. How am I going to go put $10 million?
0 to 100.
All right. Yeah. All right. Steve looks at a deal in Columbus, 130 units, 12 million. But all right, I can't do that. Okay. Yeah. But he's speaking from a position even further than where we are, right? Of been there, done that, knows the pitfalls and why, he has a reason for saying that other than, not to be egotistical, right? Mm-hmm. And it's because the more doors you have, especially out the gate, the safer it is, the easier it is. Okay. Safer in the sense of you have more diversification of your revenue or your income streams, and easier in the sense that you can afford to hire people to do stuff for you, right? What's the value of your time? I'll tell you from our experience, the smallest property we own is the hardest property we own right now. We have one property, it's 22 units, smallest one we own. Bought it 2 years ago. Definitely the hardest. We make money on it, but it's 22 units. It's not really that small, man. Like, it's not huge, but it's not, a fourplex, right? Well, where to get started? So I'll tell you what I did. Started with knowledge, man. I spent 2 years coming home after work, underwriting these small properties, familiarizing myself with how the numbers work, what's a good property, not a good property, what's a good area and not a good area. Just because the numbers work doesn't mean it's a good investment. Okay. There's a nuance to it. Like when I said the 70-75 monthly rent for 1 bedroom, but I said, you've got to be able to tell if that's a bullshit number that the realtor is putting up there, or if the rents are higher in the area or lower in the area. You have to know that stuff too, because whether you're going to invest in your own deal or you're going to invest in a deal with people like us, right? You've got to know that when they bring you a deal, if they're telling you bullshit or if they're being honest with you, right? There's people out there that are not honest, or they're maybe nothing nefarious, but they just don't know what they're doing, right? And so their lack of knowledge is going to cost you money, which you don't want. So learning the nuances of it, start with knowledge. Yeah. And then you'll be able to figure out, is this something I really want to be in? Is this something I really want to park my money in? Et cetera, et cetera. But if you're planning for retirement, yeah, I don't know why you wouldn't do something like multifamily real estate. Okay. Because if you have $1 million in the bank and that's your retirement, or you have $1 million placed with Rustbelt Capital, and you're making 8% or 10% net of fees as a distribution, that's 1/3 of your total investment return. You're making $80,000 to $100,000 a year, and your principal, your $1 million, is going up in value, not down. Versus you have $1 million in the bank, it's going down because you're drawing from it. And even some investment advisors recommend drawing from it, and I think that's a terrible thing to do.
Why? Expand on that.
So some investment advisors, when you go there, go talk to them or whatever, they'll come up with a plan and they figure out how long you have to work and how much money you have to put in there in order to be set in retirement. Okay. Part of their plan is in retirement, well, we're going to draw 3% a year off of your nest egg that you built up over your working years, add in some Social Security, and that's what you have to live off of and stuff like that. Okay. But that requires you pulling away from your asset, which is all that capital that you stacked. Okay. And once you spend it, it's gone. right? So every dollar that you go out, you hustle, you work, you trade time for money for that. If you spend it, if you go buy Cane's chicken fingers with it, it's
It's not
gone.
bad
That
investment.
time is gone. But if you take that money that you traded time for money for, and you put it in an investment that spits off money every quarter, now that time, you haven't lost that time yet. And that the value of the time that you traded keeps going up. It continues to pay you. So you can spend the dividend money. It's no skin off your back because you haven't touched any of the hours that you traded. If you have 40 years that you're working and you're stacking all this cash, as soon as you start pulling away from the cash that you stacked over 40 years, you're giving away those hours that you worked, that time of your life that you traded. But if you have something that's paying you out a healthy dividend, you're not losing that. You're not losing what you worked your entire life for.
Yeah. Yeah. And this, it's interesting because I feel like I'll speak for myself. When I hear these things, I get excited. I'm like, man, like it sounds like a no brainer, right? But
Mm-hmm.
then the gap of confidence is always in the knowledge. That's why
Mm-hmm.
you're saying start with knowledge, right?
Yeah.
When you understand the value of a deal, when you can understand how to underwrite, I'll ask you this: your investors, are they typically investing in obviously they're looking at the deal, of course, but are most of your investors people who are really competent in underwriting, or are they people who just look at your books? Obviously, they're intelligent because they've got the money to invest. They're not idiots. I would venture to say most of them aren't anyway. Are they looking at these deals and saying, yeah, this is the guy to do it? Because at that point, it's literally super passive.
Yeah.
Where are
So,
they coming at with their intentional, their initial intent?
yeah. So a year ago, I went to a conference in New York City, went up in the World Trade Center with all these private equity companies that invest in deals, or fund managers and stuff like that, family offices. They write huge checks. And they asked the same question to a group. One of the leaders of one of the private equity companies asked that question. They said, do you bet on the horse or you bet on the jockey? The
Hmm.
horse, in our case, being the deal, or the jockey being the operator, in which case we're the operator. And this guy was 65 years old, maybe older, been in the business, has no reason to have to do this. Dude's worth hundreds of millions, maybe more. And he said, I'd rather bet on the jockey than the horse.
Hmm.
Right. So most of our investors, they look at the deal. They want to know what they're investing in, but they invest in us, our dream, our vision for the property that they're looking at specifically at the moment. And they trust us to be able to pull it off. And so far, I mean, our investors have done really well on all the deals that they've invested in. Like our distribution rate, we have 100% distribution rate, meaning we've never missed a distribution payment, which is something that a lot of people can't say.
Hmm. Interesting. Okay. Let me ask you this then, man. And I want to get back to some of the previous conversation, but if somebody, and I'm pretty sure your minimum investment is 50,000, correct?
Yep.
Okay. Somebody takes 50,000, and I want to make it just simple for
Sure.
people listening and watching. Somebody takes 50,000, like, Steven's the dude. He's my jockey. I trust this guy. You know what I
Okay.
mean? He knows a good horse, but he's the jockey I want to bet on. What can they expect from communication to numerical return quarterly? And also, can you get into some of the refi cash out stuff? Because I feel like that's something that's like maybe not 101, maybe that's 202 level education.
Okay.
Can you get into what that would look like? I give you 50,000 today. What does our communication look like? What kind of returns can I expect and when? And yeah, what are the benefits in partnering with you with that from both a partnership standpoint and also a return standpoint?
Yeah. Well, number one, if you invest money with us, you get my personal cell phone number, so you can
Let's
call
go.
me at any time. Right. So that's one thing. But in terms of what an investor gets right away, every quarter, you'll probably get a check from us. along with a letter that tells, here's the top line revenue, here's what happened at the property this week or this quarter, here's any capital improvements we've done or updates on that, here's what our expenses look like, and then here's the distribution amount, but percentage wise, annualized, and then what is it relative to where it was supposed to be, from our underwriting. So you get that every quarter mailed to you. And then every week we send out I send out an email newsletter to our investors talking about what I'm seeing in the markets, trying to provide educational content. Last week, or actually this week, sent out an email with due diligence. How do we do due diligence? So when it comes to inspecting a property that we're under a contract on, what does that look like? What is that process to make sure the numbers that they say are the numbers are actually the numbers, the property's in good condition, and we don't, buy a lemon, right? So that's what communication looks like when somebody, signs up and is on our team as an investor.
Okay. Now, just to get again to the basics, what can somebody expect on a return? Because 8 to 10% is what you're saying on a typical return within an investment with Rustbelt.
As a dividend.
Mm-hmm. What does that look like? I mean, give me the numbers quarterly.
So yeah, without getting too complicated, our objective is to grow your money or compound your money at 15% a year, net of all fees, right?
Okay.
Of that, there's going to be, how do you get that 15? There's going to be 3 ways you're going to get 15%. One is debt pay down. Okay. We're paying down the debt on the property. Another way that you'll get that is through the distribution or the dividend, right? The cash flow. And then the third way is through appreciation, and it's called forced appreciation. For every amount that we raise the rents or raise the revenue on a property, that increases the value of the property. There's almost a 1-to-1 correlation with increasing rents to increasing the value of the property. And so that's where you get the secondary lift. So our goal is to basically double money every 5 years.
Okay. So what can somebody anticipate in a year in those dividend payments if they have a 50,000 investment?
Yeah, on $50,000, it depends on the property that we're looking at, but typically it's going to be on 50,000. If we do 8%, you're going to make $4,000 net. Most of that's going to be tax deferred, and probably we're going to do a cost segregation study, and that's basically we're going to take all the depreciation, right, which is a non-cash expense. We're going to pull it forward using an engineering and accounting firm and the IRS tax code that allows us to do this. And so if you put 50,000 in, you'll probably get $25,000 of bonus depreciation year one that you can use on any of your passive income, including this. So you get $4,000 of that. You're going to pay zero on taxes on that $4,000. And without doing the fancy, sophisticated financial advisor math, I mean, that's the equivalent of what, a $5,000, $5,500 pre-tax return or something like that.
Yeah.
Yeah.
Okay. And I think the 25,000. Go ahead.
Yeah, you talked about cash out refi. So
yeah.
A lot of the reason people want to get into real estate is partly for that cash out refi. And what that means is when you, like we said at the beginning, when you buy a property, say you buy $1 million property, 250,000 is coming down as equity, 750,000 you're going to borrow from the bank. We increase the rents, say $100 across however many doors that is. Then we go back to the bank a year later after we got the $100 increase. We said, hey, Mr. Banker, we increased the value of this property by 25%. It's now worth 125 or 1.25 million instead of $1 million. They look at the numbers. They look at us. They say, you're right, Steven. It's worth 1.25 million. We'll loan you $1 million instead of 750,000. They cut us a check for $1 million. We take that 750,000 replaces the original 750,000. And then we have 250,000 left over. The 250,000 left over, we give back to the investors, and that's a return of all your capital. That's the idea of the cash out refi. And most of that's dependent on pushing rents or reducing operational costs. Okay. there's a property we're doing right now that we're under contract on. Part of what we're going to do is cut the maintenance by nearly 50%. And there's a reason, like, this isn't, looking at it with rose colored glasses or anything like that. We've been through the inspection. We've done the due diligence. We've looked at all of the financial statements, and it's very realistic to be able to do that, right? And there's reasons behind why it's so currently high and stuff like that. But then the other thing is we're able to push the rent. So we were able to get a win-win, right? Lower operations expenses and higher revenue. Okay. So we'll put a certain amount of debt on it for now, get us through 3 years, improve the financials so that the bank likes what they see. And then we'll replace all of that and hopefully give all of the money back to the investors in year 3.
Year 3. So is that usually the goal, that time frame, about 3 years?
Year 5.
Year 5.
Year 5, somewhere 5 to 7 years. 7's things happened. But typically we're shooting for year 5. This one's an abnormally nice deal in terms of getting your money back. The first year is going to be a little bit tighter on cash flow. And there's some variables in there on this deal as well. It's not always, this is why somebody would want to partner with somebody who's been there and done that, because there's a lot of nuances. Going back to the 775 rent thing that we said, is that the right rent? There's a nuance to it. You've got to know, eat, and breathe everything about that to know here's what the numbers say, but here's what is reality, right? The numbers might say one thing, but in reality, there's something different. The newsletter that I sent out this week was about that. We do a financial due diligence. We look at every single lease. We look at profit and loss for the last 12 months. And then if we have to, we'll go through every granular line item expense that they had for the last 12 months to figure out how many of it's ours versus how many of it's this versus what are they spending money on and all that type of stuff. Okay, that's the financials of it. What does the actual property look like? Okay, because it could have clapped out roof, clapped out siding, windows could be falling out of this thing, but the numbers look good. You have issues, or the numbers look good, but then you walk the units, and we walk every single unit, and we check everything. What type of electrical system is in there? What type of wiring is in there? How old's the HVAC systems? Do all the plumbings work? What does it look like underneath the sinks, right? Is there any rotten, do all of the garbage disposals work? Stuff like that. That's where you find out from the numbers to what's the actual real deal, right?
Yeah.
So it's merging the two, and there's a nuance that it takes reps to see to make that work.
Yeah. Well, you listing all these things off, things I wouldn't even consider, like what kind of electrical system, like that's not something that, these nuances, there's a spectrum, and I'm assuming they probably vary from location to location as well.
Yeah. So electrical boxes, why do we do breaker boxes is what I'm talking about. Why do we do that? Well, there's I don't remember the name off the top of my head. But I have it written down when I go through an inspection. If it's that certain type of electrical box, insurance won't cover it. If you have aluminum wire versus copper wiring, that's an insurance problem. And insurance is a huge line item, right? You go and you want to see underneath the sinks. Why do you want to see underneath the sinks? Well, that flooring in the sink, is it rotten out or is it not rotten out? If it's rotten out, that means there's been leaking and plumbing issue, right? Well, that's going to cost money to fix. Even if it's not leaking now, it's probably going to reoccur. You want to see who's living in the units, right? Are they going to treat it nicely? Are they going to treat it hard? Who is it? Is it somebody that we can raise rents on, or is it people that are probably more fixed income? What's their scenario? And it could lengthen or shorten how quickly you can change rents or you can adjust things, right? But you wouldn't know that until you look and see every single unit. You're walking a property and it's 2:00 in the afternoon on a Tuesday and everybody's there. That's a problem.
Yeah.
Right? That's not good.
Yeah. This is interesting, man. So look, man, your first deal, like all these nuances, all of this knowledge, all this experience, I understand you did the 2 years of underwriting, but there's no way that you could have learned everything at first just underwriting, right? What failures were there? The first deal you did, you go to Nate, you're like, hey man, I've got a deal. You feeling the pain already, reliving the nightmares. What were the failures up front, man? Because there's a ton of moving parts here.
All right, dude. So we close 64 unit deal. There's an office. Been in the office one time. We close. I'm feeling like, dude, hell yeah, brother. It was good. All right. All right. Go down the street, go to the property, walk in the office. There's a door, right, to the maintenance part. And I've never been in the maintenance part because, all right, that would have been smart to do, but I didn't. Walk in the maintenance door. There's all these window shakers, all these window AC units. And I'm like, that's weird. Why are there so many window AC units, right? And we bought it when it was still cold and it's getting warmer. Bro, there's a lot of HVAC components that were broken, right? The entire tons of them, right? And at that time, we didn't walk. We ordered an inspection. Really good inspection company comes out, and we have them come in and do a selection of units. And then neither one of us walked every other unit, right? Which is, dude, you need to walk every unit, okay? And have a checklist. Like I've got a checklist over here on grading a unit, right? Very standardized. But dude, there's like 10 or 15 HVAC systems that were clapped the hell out day one. So we get a quote.
After the deal's closed,
bro,
right?
we get a quote. It's like 10 grand a unit. I'm like, bro, that's 150 grand. It didn't take account for. It's like, this is bad. This is not good. It's not good. Thankfully, we figured it out. We were able to limp along, and that property is doing fantastic now. I mean, it's a home run investment or whatever, but we had fat in the deal. Now, if you don't know what you're doing and you're in a very competitive market and you do something like that, dude, you're upside down. Yeah. And you might not be able to come back from that. And all that money that you put into it, gone. So thankfully, we were okay.
How do you when you limp along, what does that even mean? Like, did you go find another 150? Like, did you ask to restructure the deal after it's closed? Because they're not going to do that. You signed, sealed, and delivered, right? Like,
no. So limp along is we had some extra cash when we closed, right? You always want to have an operating budget, and you always want it to be healthy. You don't want it to be too skinny. And there was enough cash flow. Like we were making 12% plus a year and cash on cash, meaning our total return's higher than that, but we're netting out 12%. So if we cut it back to 6 or 7%, we can take care of those units and we can still use some of those window shakers or whatever to keep the tenants happy at the time. But man, that was it's a boneheaded move, dude.
I'm gonna venture to say that that didn't happen again.
That's why we walk every single unit and we test every HVAC system. Every piece of mechanical equipment gets tested. Where the water meters for the buildings gets looked at. Is it in a vault? Is it above ground? Because if it's in a vault, dude, that's not a good sign, right?
Yeah. See, this is the nuance, though, man. This is the nuance. And did you have a mentor or something? Like, how do you learn this stuff? Like, obviously by failing is one of the ways you're learning, but like the hard way. But did you have a mentor? Is this stuff your research? You're a mad researcher. You're an avid reader.
Yeah.
All these things. How do you learn?
Dude, there's only so much reading you can do until you just have to do the darn thing, right? And so every deal we do, we get smarter, right? So every deal you do, you get smarter. Getting these checklists, right? So I don't know if I have it with me, but I have a unit inspection sheet, right? And it literally asks yes, no questions, and then it has 3 things that need to be graded on a scale of 1 to 10, right? What's the unit condition quality? What's the wall condition quality? What's the cabinet condition quality? Why do we ask cabinets specifically? Because if the cabinets are good, that's an easy fix. If the cabinets are bad, that's an expensive fix, right? You could, if you've got good cabinets, you just need to change the countertop. Maybe you need to give a new face. Maybe you need some new doors or something like that. That's easier to fix. But if the tracks don't work, if the hinges are crap, and the floors are beat up, that's a problem. That's a lot more expensive, right? So how much money is it going to take to turn a unit and turn it back to pristine? Is there wallpaper? Is there not wallpaper? Wallpaper is a pain in the ass. Very expensive to remove and clean up. Just you don't know that until you do that, man.
Yeah, yeah. So when you said up front you want an operating budget up front, some cash on hand, things go wrong,
Yeah.
things pop up, right? That saved you. How much is there like a standard, like we should have this much, depending on the property value here, considering our overhead, obviously maybe just seeing what's going to need to be replaced in the next few years. Like how do you find that initial operating budget getting started? How do you allocate?
Yeah. So rough rule of thumb is 100,000 per 3 million. So
Okay.
if you buy $3 million property, you want at least $100,000 in backup cash. And that's just cash sitting in the bank. Don't put it in a CD. Leave it in your checking account.
Okay. That's standard kind of rule of thumb you said for 3 million?
Yeah. So if you buy the property for 3 million.
Yep. Okay.
Now, if you have a $3 million equity investment and the property's $9 million, you're gonna have $350,000 of oh shit backup cash.
Got you.
You're like, man, that's a lot of money. It's like, dude, that's a lot of doors.
Yeah.
Yeah. If it takes $7,000 to $10,000 to turn over some really tired units, you got 10 units. That's $100,000.
Yeah. Yeah. Just in case there's some window shakers that need replaced.
Them freaking window shakers, man. We had to use them sometimes. Okay.
So, I want to get into your book a little bit, man. You wrote this book, An Infinite Game, and I want to kind of start with like your inspiration for writing this. It's a super palatable read. It's nothing that's like makes you feel stupid. I feel like you do a great job explaining it. Plus, you got a glossary in the back for all the definitions and stuff like that. What was your inspiration for writing this? And then I want to ask you some questions specifically about the book.
Yeah. So the book's designed to be read. What do I mean by that? I mean, very simple. I write it like I talk and I keep it short. So it's significantly less than 100 pages, right? But I try to condense all this stuff into a very meaningful, you're not reading a bunch of fluff and wasting your time. The inspiration for the book, I wanted something for our investors because they always ask, they want to do their research, they want to do their homework. They ask for, what book would you recommend reading? And I guess the best way for me to tell you or to show you everything that I know is just put it in a book form, right? So I think there's a portion in there on underwriting, and I actually go through the numbers and go through a case study with you on that. I show you one of our properties that we did and do the whole case study. Here's where the rents were when we bought it. Here's what we paid for. Here's the debt. Like literally, everything about the deal that an investor does, right? Or that I do. And just to bring somebody a lot closer to our world that we do every single day. And the name, An Infinite Game, is because it is an infinite game. That comes from our investment philosophy, right? So if we cash you out, if we do a refi at year 5, your return then is infinite because you have no money invested in it, right? You got all your money back. So now you have an infinite return and you can hold on to it however long you want, right?
Yeah.
And our investment philosophy is very long-term. We don't buy property if we don't intend to own it for 10 plus years.
Okay. Speaking of this infinite game, there's a chapter, it's chapter 3, titled Scale Perception Distortion. This was one of the more interesting things to me because this kind of comes into the same probably just that same underwriting era where it's like, oh, it looks good on paper. We're gonna, I can see this thing and the infinite game and the trajectory of this investment, but there's also nuance there as well. Can you break down a little bit about what you wrote in chapter 3 relative to the perception distortion?
Yeah. Tell me first when you read it.
Yeah.
I don't know if I have it. I have to look through What chapter was that?
Chapter 3. Yeah. So I'll one of the things that's bold that I pointed out or I underlined here is $1 million feels like it's in the same realm as 10 million, yet the gap between them is monumental. So what does that mean? Obviously, right now, afterwards, you follow up with the difference between the two is literally the definition of an order of magnitude. What does that mean?
An order of magnitude is 10 times different, right? It's 10x, right? So the example I use is like you can save your way to your first $1 million. For example, if you made 100,000 a year and you just stacked it, you'd be at $1 million in 10 years. But if you tried to use that same approach to get to $10 million, it'd take you 100 years. And very few people live to 100.
Yeah.
Okay. And that whole idea,
you're making 100,000 since you're 1 year old.
Yeah. Right. And the idea behind that is to give you a wow factor of like, we can get in a fur-lined rut where we feel very comfortable and we feel like we're making progress, but we're using the wrong measuring stick. And what can we do to blow up our current mindset to realize, dude, I'm not getting as far as I want to get. Right. And what do I need to do that's different to get to where I want to get to? You know, I had a goal to have a net worth of $10 million, right? Plus by the time I'm 35. Okay. Well, what's it actually take to get there? Okay. It goes back to the investing thing. If you're going to do what everybody else does, expect the same results. You're going to put your money in just a tiny little better stock. And you're going to make 11% instead of 10%. It's insignificant. But if you can put your money into a better opportunity vehicle, dude, totally changes your end result, right? Warren Buffett, he went to Columbia Business School, right, with a ton of other students, and all those students were super smart. I've never been accepted into Columbia. All right, I ain't that smart. Yeah, you're not there, so we're neither one of us is that smart, right?
Yeah.
But Warren Buffett's one of the most wealthy people to ever live. Okay. And all those people, we don't know any of their names that he went to school with. Like, who the hell are they? I don't know. Right. What's the difference? The opportunity vehicle that he took. Okay. Yeah. So it's just make sure you're in the right opportunity vehicle, man.
This is interesting, man.
It could be the business that you're in day to day. It doesn't have to be with Rustbelt, right? The business that you're in, the questions that you ask. Sometimes I'll give you this example. I can't tell you how many times we take over properties and the previous owners only wanted to raise rents $10 a year. For example, when we bought our first property, the 64 unit property, walk in and say, hey, we're raising rents across the board by $50. The person sitting in the management office had a shocked look on their face. And I said, why? What's going on? And she's like, typically we only raise them by like $15, $20 a year. It's like, you're so used to what you know. They don't ask the question. And a simple yes could accelerate the snot out of where you are, right? Today, we've owned that property for 3+ years. We're almost up $200 a door in rent, right? So we've made well over $1 million on 64 units, right? So just, yeah, sorry.
No, you're good. That makes sense. So this is the interesting thing for me. And again, I think we could probably spend so much time here, man. And I also want to respect your time too, man. It's finding the right vehicle. And this is bold writing that, I mean, literally in the book, it's in bold writing. The importance of the opportunity is the vehicle you choose. And then you go on to say, this is the question that separates exponential growth from those who remain on a linear trajectory. Now, that difference, how much of that comes in understanding leverage?
Everything.
Okay.
In leverage, okay, so leverage doesn't have to be debt. Okay. As an investor, when you have your capital deployment mechanism, yeah, you're thinking about debt. But leverage can be marketing, can be the people that you have, right? Maybe it's better paying somebody $50 an hour, which is $100,000 a year, and having one of those than having 3 people you're paying $25 an hour. So 75 an hour.
Yeah.
You might make substantially more, right? So hiring quality people, that's leverage. People in your business, like there are people that work for us. This is not just the Steve-O show here, all right? It's more than just me, okay? Leverage in terms of your network. Who you know is just as important. For example, just this past weekend, the broker that I had been building a relationship for 3 years with, who brought us the deal that we're doing right now, that has a ability to probably double our money in 3 years, invited me to an event. Okay, so I went to this event on a weekend, late at night. There's tons of people in the room. So I looked around. Guess what? Everybody in the room was owners of multifamily. As a matter of fact, there's 5 people who own probably almost all of the multifamily in Northwest Ohio. There's one guy there that owns over 5,000 apartments himself. Okay. Wild.
Wow.
I sit down next to this older gentleman. I have no idea. I'm a shy ass guy. I don't really like talking to people. Yeah, I see this guy. I'm like, I got awkwardly introduce myself to him. Tried to do small talk. All right. Okay. Not cool. Did that. Asked a few questions. He wants to trade his number, blah, blah, blah. Later out, I find out who he is. He gives me a call literally today about wanting to invest in a deal. And he owns hundreds of apartments on his own. And he wants to do a deal with us. And how does that go into leverage? Who you meet. Okay, there's more money that's coming in, more relationships that's coming in, more opportunities that's coming in just by knowing people that I otherwise wouldn't know. Got another call literally today again. Guy that raises money, millions and millions and millions of dollars, and he wants to do a deal with us as well. I'm like, well, I don't have enough deals for everybody right now. All right, let's go calm down.
Good problem to have.
Yeah. But it's just from knowing people and talking to people and putting yourself out there. And that's a form of leverage, right?
Yeah. 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 Speaking of bad vehicles though, because that leverage thing, that's honestly like when I first started getting into just studying real estate, that's the word that pops up everywhere. OPM, other people's money, right? Whether it's an investor, whether that's lending, but I love that you're breaking down the idea that leverage is so much bigger than that. Leverage is simply opportunity you didn't have otherwise. Right.
Mm-hmm.
And
yeah.
so outside of that, say you're good at that, right? You know people who want to invest because they trust you and you've been successful in X, Y, or Z, whatever the case might be. Guy that owns 5,000, I'll ask you that after the call, but he calls you, he owns 5,000 and he calls you wanting to invest, like essentially the new kid on the block, right? like incredible.
Been in the game longer than me. Yeah.
Yeah, probably longer than you've been alive from the sounds of it.
Definitely. Yes.
It's wild to me. So, but after that leverage in whatever way, shape, or form you have it, find it, or have the skills of collecting. There's also going back to this bad vehicles. Speaking of, in your book, one of the chapters, and I quote you, I hate these properties as an investment, referring to triple net properties, like all caps, you hate it. That's a bad vehicle. You also refer to it, you say this is actually just a bond investment.
Yeah.
Why are these can you break down what triple net means? You break it down in the book, but can you break down what a triple net is and why that is a bad vehicle?
So that comes down to just being an investor first. And what I mean is, in life, a lot of times people present things as one thing and in reality it's another thing. And it's up to you to sniff it out and saying, oh, this is not actually as it seems, it's XYZ different. I think Hormozy talks about it as frameworks, mental frameworks.
Yep.
So what is a triple net lease? Triple net lease is basically the tenant it's for commercial usually. The tenant pays the taxes, the insurance, and the maintenance on, that's where the triple net comes from, on the property, right? And Usually it's a single site place. So it's like a standalone Rite Aid or Starbucks or something like that. There's specifically built for one business. There's, it's not a strip mall, nothing like that. It's specifically built just for that one business. The reason I don't like them is because essentially what that is a bond investment. You're investing in the prospects of whatever restaurant, whatever, if it's a Rite Aid, you were investing in the hopes that Rite Aid would continue to pay you, okay? But you don't participate in any of the upside if they do better. But if they suck and they go broke, which Rite Aid did, okay, you're left with a purpose-built building that's very expensive, and now you got to go release it, right? And if it sits empty for years, you have carrying costs. Who's paying the mortgage? Who's paying the taxes? Who's paying the insurance? Okay, that's on you, right? And this is specifically super important. Like I can name you. Look at Red Lobster. Okay, they're having trouble. Rite Aid went bad. Big Lots went bad. How many other stores are going to go broke like that?
Yeah.
And that's going to be more and more true as interest rates stay high, because some of those companies were bad businesses, like Big Lots, and they were staying alive because debt was so cheap. And now that debt's actually cost something, they can't. Their margins are so bad that they won't stay alive.
Yeah. In comparison, though, to complexes, multi-unit investments, first of all, once you're out, you're out. You have no cash flow. Rite Aid goes under, you're done. Whereas
negative, yeah,
negative immediately.
Feeding it in the wrong way.
Yeah, exactly. It's eating itself. Now, if you have a complex, you lose 10%, you still have cash flow. You lose 10% of your tenants, even if because you've projected that, you've anticipated that in your budget. But not only that, you're going to lose some anyway. At that point in time, you still have tenants, you still have cash flow. So it's also a safer investment.
Yeah, you have diversification of your revenue streams. Instead of relying on one big check every month, we're relying on hundreds of smaller checks every month. And if a few people don't pay, that's fine. We've already accounted for it. It's kind of like a credit card company, right?
Yeah. Okay.
They've accounted for people not paying their credit card.
Yeah, exactly. Which I heard they're lobbying for lower maximum interest rates on credit cards. Who knows? What other bad vehicles are out there that are often perceived as good vehicles? Obviously triple net's one of them, but are there any other ones that you just hate getting in?
So I'll tell you what my typical day looks like, right? So kind of taking a little bit of a different direction. Most of my job is to say no.
Okay.
So we'll look at 1,000 units and buy 70, right? So I can't tell you how many deals come across our desk or calls that I get from brokers. I've had several this week. They tell you about a deal. You tell them, sounds like a really nice deal. Unfortunately, you're not interested in at this time, or you can't take it on. Or you look at it and then there's not a reason to go forward with it. So 95% of the time you're saying no to things. And I think that's a lot in life, right? If you're a business owner, you're presented with lots of different opportunities, right? We have a lot of yards that need mowed. Okay. We could open up a landscaping company. We could do it in house, right? We could make money. And then when they're not mowing ours, they could go mow somebody else's. That would be a bad business for us to own, because it takes away our mental bandwidth, right? Where are we going to make more money? Focus on what we're good at, right?
Yeah.
So I think when it comes to business owners, it's stay hyper focused. Okay. You ever walk into a restaurant and a menu's like a bajillion things long?
Yeah. The Cheesecake Factory.
Yeah. But then what are some of the best businesses? Look at Chick-fil-A. They focus only on chicken.
Yeah.
Look at In-N-Out Burger, Whataburger.
Yeah.
A very small burger menu. Look at Five Guys. We only do burgers and an obnoxious amount of fries. Okay.
Yeah.
And those businesses are worth billions. Look at Panda Express. Okay. Very limited menu. That's not a public company. It's owned by one family. billions of dollars. They'll open up 700 restaurants this year. Okay. So focusing on one thing. So if you're a business owner getting distracted, that's your biggest risk. That's your worst investment.
Yeah, that's good. Pocketing that one, man. Considering politics, man, I think a lot of people, man, I mean, we see the market tap, like even right now, markets are just crazy right now, right? Volatile.
Mhm.
What is your take on taking the political environment into consideration with your investments?
Yeah, making investments based on politics is a very dangerous game. Okay, you should do what you're going to do regardless of who or what party's in office. You can make a shit ton of money if a Democrat's in power. You can make a shit ton of money if a Republican's in power. A great story, a great synopsis of this is you can even make money if you buy at a wrong time.
Hmm.
Blackstone, everybody knows Blackstone, huge private equity company, maybe one of the largest real estate owners in the world. They own I think it's $1 trillion of real estate.
Jeez, oh beats.
Wild. They bought equity office properties, a REIT, 2007, which was publicly traded. And they paid like a 33% premium to the public market price to buy equity office properties in 2007. What the hell happened in 2008? Uh-oh.
Hit the fan, yeah.
Yeah. Yeah, not good. And
Yeah.
you look like an idiot, right? They like more than tripled their money on that investment. Even though they overpaid, they bought at the worst possible time to buy real estate, dude.
Yeah.
The worst possible time. And they still made a killing on this thing. Okay. And that goes to have a really good business plan. You got to be longer term, it can't be emotional, and you got to execute.
Yeah. Yeah. Man, this is
Look at how many different presidents they had over that course of time. You had Bush, you had Obama, you had Trump. I mean, geez, swinging all over the place.
yeah, man. And man, I feel like I've got so many questions, man. Boy, it happens every single time, man. This happens every single time. But this has been extremely valuable, man. I think we've covered a spectrum, and I love the fact that you're really good at demystifying a lot of this stuff, right? And that's just it speaks to your knowledge of as an investor. Um, do you see yourself changing directions with investment anytime soon outside of multi-unit, or do you feel like this is the ticket?
So that's a hard question that you don't want to get tunnel vision and drive into a wall,
Hmm.
but you also don't want to get distracted. So as we sit here today, our chief focus is on executing relentlessly and paying attention to what we got going on right now. Right, this year we're in position to grow 125%,
Nuts.
which is good. But our long-term vision, which we don't worry about too much, is to be $1 billion company, right? So we're on track to do that. But how do you get there? You do one good deal after one good deal. You
Yeah.
execute like crazy.
Yeah. I love it, man. I love it, dude. Any last words, man? I don't want to take up too much of your time. We've covered a spectrum of topics inside just the idea of investing and just, man, just getting inside your head just with the experience, man. It's always fun to do that, man. Anything else you feel like we haven't covered here that you want to touch on relevant to investing, business?
I think I'm better spoken in my book, right? I
Yeah.
think
Yeah.
you read this, you'll understand way more because you'll see
Yeah.
it. Very simple read. If you want it, you can go on Amazon and get it for $5. Made it. I think that's how much it costs to print. I don't know, but it's an infinite game. Get it on Amazon. If you want to be on our investor list or you want to hear what we talk about every single week, go to rustbeltcapital.com. And in the footer, put in your email, and you'll get an email every week from us, and a welcome series email that includes videos that are done by one of your recommendations. So
Amazing, man. Amazing. Yeah. The book's awesome, man. It's a super easy read. A lot of good information in here, especially when you're wanting to understand what the heck any of this is. Great entry level education, but also gets into the details as well. Let's see how many pages it is, man. 45 pages, I think, before the glossary. Highly recommend it. We'll link it in the description on YouTube, Spotify, Apple Podcasts. Brother, I appreciate you, man. Yeah, go ahead. Go ahead.
I think it's a good return for your time.
Yeah, and it's $5. Don't be cheap. Don't be cheap, guys. Get some knowledge.
Yeah. I can't make it any cheaper. I literally tried.
Yeah. I mean, if you're struggling over it, let me know. I'll buy the dang book for you. So.
All right. Yeah.
I appreciate you, brother. Thank you for your time. We'll have to do it again, man. Thank you.
Yes, sir. Thank you.